We're jumping straight into HIMS and HERS today. Everyone is watching the price action. But the real story is the regulatory crackdown on compounded weight loss drugs.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of this legal drama, and trust me, it is a drama, make sure you subscribe and hit the like button.
Oh.
We're here to simplify the chaos of the market for you, and your support, well, it really helps us keep the data flowing.
It does.
So it's February 7, 2026. If you looked at your portfolio or, the headlines after hours yesterday, you saw HIMS and HERS take a massive hit.
A massive hit is right. We're talking a sharp decline, down over 12% in after-hours trading alone.
And that kind of price action, it gets your attention. But this isn't just a bad quarter.
No, not at all. That's what's so critical here. We need to parse exactly what triggered this. This isn't a missed sales target. This is about the Department of Health and Human Services, the HHS.
Right.
Their general counsel has officially referred the company to the Department of Justice.
And that is the sentence that just stops you in your tracks. Referred to the Department of Justice.
Yeah.
That's not a simple compliance check.
It creates a completely different risk profile. We aren't talking about a slap on the wrist for a marketing claim. This involves potential violations of the Federal Food, Drug, and Cosmetic Act and, significantly potential Title 18 federal crimes.
So this elevates the risk from a business challenge.
To an existential legal crisis, literally overnight.
Okay, we're going to unpack what that means for the stock later on. But I think to really understand why this drop feels so violent, we have to look at where we were just, say, 48 hours ago.
You have to, because up until this news broke, HIMS and HERS was, arguably the growth darling of the entire sector.
It absolutely was.
And it's important to establish that context, the bull case, because that explains why so many investors are now trapped. The story was all about revenue velocity. This company, they figured out how to scale with incredible speed.
Speed is the right word. I was looking at the numbers from last year, Q2 2025. They pulled in, $544.8 million?
Yeah, $544.8 million. And that was up 73% year over year. That's the kind of hypergrowth you usually see in early stage software, not consumer healthcare.
Even with some natural slowing, Q3 was still huge.
Oh, absolutely. The law of large numbers always kicks in. But even in Q3 2025, they were still doing approximately $600 million in revenue. That's up 49%.
So growing almost 50% on that large of a base, that proved to the market there was massive sustained demand.
It did. And it wasn't just empty calories. For a long time, the knock on these DTC health companies was that they were just burning cash to buy customers, growth at all costs.
Right, but that story had shifted for HIMS and HERS.
That's the key pivot. That's what drew in the smart money. We call it the profitability inflection. By Q3 25, they weren't just growing the top line, they were making real money.
How much?
Nearly $16 million in net income. And if you look at adjusted EBITDA, which is a good proxy for cash flow, it was over $78 million.
So they had cash. They had leverage. They had a cushion. This wasn't some desperate startup anymore. They looked like a mature business.
That profitability matters. It proved the business model worked. It validated the whole idea that you could bypass the clunky old healthcare system and go straight to the consumer.
Let's talk about that model, because that's really their moat, isn't it? The direct-to-consumer advantage. They built a brand that people actually recognize.
They did. And in healthcare, that's incredibly hard to do. They accumulated a massive amount of customer data. That data creates stickiness. Once they know your history, your preferences, it's just annoying to leave.
And they spent big to make sure you knew them. The branding was slick. Remember that Super Bowl campaign?
The era of health as a luxury is over.
Oh, yeah. That was a definitive moment. It signaled they weren't just a pill dispenser for, hair loss anymore.
They're positioning themselves as a leading health and wellness platform, the front door to healthcare for a whole generation that just wants convenience.
And to be fair, they back that up. I think people still pigeonhole them, but they have mental health, dermatology.
Even multi-cancer early detection testing. That diversification was a huge part of the bull thesis. You come in for one thing, but you stay for something else. It increases the lifetime value of every customer.
And Wall Street bought it completely. The expectations before this news, they were projecting huge things.
A banner year. The consensus was projecting earnings per share to grow by over 79%, from about over 29 cents to 52 cents per share.
So effectively doubling their profit.
Explosive bottom line growth.
Okay, so let's just recap the vibe before the bomb dropped. You've got 50% revenue growth, you're profitable, you have a killer brand, and Wall Street thinks your earnings will nearly double.
It looked like a rocket ship, a perfect setup. But as we know, when a stock is priced for perfection, any crack in the foundation can bring the whole house down.
And this wasn't just a crack. The government walked in and condemned the building. So we had to pivot to the bear case because the ground just completely shifted.
It did. The entire bull case we just described relied on one assumption, that their business model was compliant. This news challenges that to its core.
This is where we have to get technical. This is all about compounding.
All right. Let's break down this first risk, the existential regulatory threat. The headline is the DOJ, but the root cause is the FDA taking decisive steps to restrict these compounded GLP-1 drugs.
Okay, so for the listener who hears compounding and just thinks of, I don't know, high school chemistry, what's really happening here?
So here's the mechanism. Approved drugs like Ozempic, they're patented and made by Big Pharma, in this case, Novo Nordisk. Because of the huge demand for weight loss, these drugs went on the FDA's shortage list.
And that list is the key. Being on that list changes the rules.
Precisely. When a drug is on the FDA shortage list, the law lets pharmacies compound versions of it. Basically, they can buy the active ingredient semaglutide and mix it themselves to meet patient demand.
So it's like a safety valve, a backup plan.
It's supposed to be a niche exception. But HIMS and HERS, they took this loophole and they industrialized it. They realized they could mass produce this stuff and sell it for around $49 a month.
Compared to, what, $1,000 for the brand name?
At least. So they took a rule meant for emergency fill-ins and turned it into a primary business model. That $49 price point was their superpower.
But now the government is saying, wait a minute.
Exactly. They're saying this isn't a backup plan anymore. This looks like mass manufacturing of an unapproved new drug. And now that the shortage of the brand name stuff is easing, the legal justification for compounding is just vanishing.
And that's where the DOJ comes in.
That's the heavy part. Civil violations are fines. But criminal violations under Title 18? Well, that can mean executives facing charges or the business getting shut down. It terrifies institutional investors.
Which leads us right to risk number 2, the revenue cliff. We said they're diversified, but let's be real. How much of this growth was from weight loss?
That's the scary math. We estimate that segment is likely 30 to 50% of their recent growth. It was the engine.
So if the DOJ or FDA shuts this down, that revenue doesn't just dip.
It evaporates. It creates a massive hole in the income statement. And that 49% growth rate, it collapses. The growth story is dead on arrival.
Then there's risk 3, margin compression. These compounded pills were cheap to make, right?
Extremely cheap, high gross margins. If they lose this, they might try to pivot to selling, the official Ozempic.
But then they have to pay Novo Nordisk.
Exactly. They become a middleman again. Their margins get crushed. We could see gross margins drop by 300 to 500 basis points. They go from a tech platform back to a low-margin distributor.
Wow. And, there's a fourth risk that people might be overlooking because the legal stuff is so loud. Even before this, they were having some execution issues.
They were. This is the misses part of the story. They missed earnings consensus in Q3 2025. Delivered 9 cents when the street wanted 10. They missed in Q2 as well.
So the business was already showing cracks. Revenue growth had already slowed from 73% down to 49%.
Correct. So you have a cooling business that just got hit with a regulatory sledgehammer. It's a very dangerous combination.
Okay, so the picture is bleak. The stock is down big. The DOJ is circling. What does this all mean for the next 30 days? What are the dates people need on their calendar?
We have to look forward. The most critical event is coming up fast. February 23, 2026, the earnings call.
The Q4 earnings. But I'm guessing nobody really cares about last year's revenue number this time.
The historical numbers are irrelevant. The only thing that matters on the 23rd is what we call the compliance roadmap. Management has to get on that call and explain in detail how they survive this.
So what are the scenarios? What are we listening for?
Scenario A is the fight scenario. They come out swinging, say, we are legal, the DOJ is wrong. That's high risk. That means uncertainty for years.
And scenario B.
Scenario B is the pivot. They announce they're voluntarily shutting down compounding to appease regulators and shifting to selling approved drugs.
Safer, but it kills their margins.
It does, but it removes the existential threat. If they're vague or dismissive on that quell, this stock has much further to fall.
What else? There's guidance.
Absolutely. Event number 2 is the guidance revision. Remember we said analysts expected $1.52 in earnings for 2026?
Yep, the profit doubling.
Watch that number like a hawk. If management guides 2026 EPS below, say, $3.45, it confirms the business is shrinking. It confirms the growth story is over.
And then, just after that, they have to face investors in person.
March 2nd, the Morgan Stanley Tech Conference. They have to sit on a stage and answer questions face to face. You can't hide behind a press release there. If they look rattled, the stock will sell off.
There's one more thing. The customers. What about churn?
The silent killer. Imagine you're a subscriber. You see headlines about your medication provider being investigated for illegal activity.
I mean, I'm probably canceling, or at least thinking about it very hard.
Exactly. We won't see those churn numbers immediately, but if they mention customer hesitation on the February 23rd call, that is a huge red flag.
It's a lot. This company went from hero to zero, or at least under investigation, in the blink of an eye.
It's a classic reminder of regulatory risk. When your business model relies on a loophole, you're always at the mercy of the regulator closing that loophole.
So let's wrap this with the lowdown. How should people think about HIMS and HERS right now?
You have to recategorize this stock in your mind. This is no longer a growth story. It is now a turnaround play. And those are very different animals.
Right, a growth story is buy the dip. A turnaround play is wait and see if they survive.
Precisely. The price drop might look tempting. It might look like a discount. But that discount reflects the risk that the core business model itself could be deemed illegal.
So don't be a hero.
Unless management comes out on the 23rd with a crystal clear plan, this uncertainty is going to last 6 to 18 months. DOJ investigations are not quick.
So the final word is keep your eyes on the 23rd, listen to the tone, watch the guidance, and for the love of your portfolio, don't catch a falling knife without a glove.
Couldn't have said it better. Wait for clarity. Cash is a position, too.
That is the lowdown on HIMS and HERS. A high-speed collision between innovation and regulation. We'll be watching that February 23rd call closely.
And it raises a really important question for the broader market, you know. How many other telehealth companies are sitting on similar regulatory fault lines? Something to mull over.
That is a scary thought. A little homework for you. Go check your holdings. Make sure your disruptors aren't just rule breakers. Thanks for tuning in to the Easy Money Show.
Stay safe out there.